Smart and Final CEO David Hirz ringing the opening bell at the New York Stock Exchange today, celebrating the company's one-year anniversary as a listed public company. Nice to talk to you.
Thank you. Good to be here.
So what was the biggest lesson learned in the past year?
It's been a great year. We went public a year ago this week, and the reason for going public was really to raise money to support growth. And there's been a lot of learnings with that. We've opened 16 stores since I was here a year ago, and they're going great. We've learned a lot about opening new stores, though.
And you're going to continue to open more stores. You're on plan to do that. Tell me under which banner these stores will be, and primarily where will they be located?
Okay, good question. We announced this morning Project 100, which is our goal to open 100 stores over the next 4 years, and it'll be a mix between Smart and Final Extra stores and cash and carries. Predominantly, all of the stores will be in the 6 western states that we operate in today. We've been in this market for over 140 years, so it's a market we know really well. We have 9 distribution centers, and we think there's at least 180 opportunities still remaining just in those 6 states.
Any plans to expand beyond the West?
Eventually, the answer is yes. We think the model is really portable. We've done white space studies across the U.S. We believe there's about 1,200 opportunities for us. But for now, the growth is really focused on the 6 western states. We will introduce 1 new state in 2016, but for now it's the 6 states. And the growth will be 10% a year. So a Smart and Final will end this year with 221 stores. In 2016, we'll open 22. And a Cash and Carry will end this year at 55. And in 2016, we'll open 5 new Cash and Carries.
So the grocery store business is very competitive, typically very thin profit margins. So tell me how you look at your gross margins, how you kind of muscle your way into some of these markets.
Sure. The reason that we can compete the way we do as a value retailer is because we have a really low cost structure. Our stores are smaller than most at 25,000 feet. They're high productivity, no service departments, and we price really competitively in the market. So we think value is a new normal, and we've been able to compete really well these last several years.
You mentioned in your second quarter earnings report that there was some deflation with certain products. What are you seeing in terms of your own pricing power now?
There was deflation in the second quarter, and it's continued in the third, but not as strong. But margins have held up really well in this environment. In the deflationary environment, we've been really happy with where margins have ended, and pricing power has still been very strong for us.
Now, are you using debt to finance some of the expansion?
We're not, no. We actually, when we went public a year ago this week, we paid down some debt to get about to a 3 times debt ratio, which is we're really comfortable with. And the rest of it we put in a balance sheet, which will fund our growth going forward.
Any concerns as the interest rate environment changes for either your business or your customers?
No, not at this point. It doesn't look like it's going to in the near term, but no, our customer actually is healthy. The economy for our customer has improved. It's improved really slowly, and again, value is a new normal. I think there's been a real shift there, but we have no concerns going forward.
Have you seen any impact from lower gas prices? We always hear that gets the customer out buying additional things. Are you seeing that with your numbers at all?
We haven't. We wish we were. We looked at it when the gas prices initially dropped. We were looking for the impact, and we really didn't see an impact. Our same-store sales have been really strong the last 3 years or so, but no real change during the lowering of the gas prices.
And finally, in terms of your expansion and opening new stores and hiring people, because you will be doing that as well,
sure.
Are you feeling pressure with the increases on the minimum wage front?
No, we pay very competitive wages in every market that we operate. The minimum wage in California in January actually goes to $10, and we think we're in really good shape. Our average hourly associate, take out the store management, our average hourly associate makes almost $14 an hour average rate, so we're much less impacted by minimum wage increases, and we think the minimum wage increase could put extra dollars into the hands of that value consumer, which could be good for value retailers.
David Hirz, great to talk to you. Thanks so much.
Thank you. Appreciate it. Thanks for your time.